Hi, everyone. So now we're going to look at examples of candidates that were able to demonstrate competence and those that demonstrated limited competence. And we'll start off by looking at task A, and then we'll go on and look at task B. So if you look at candidate A here, which is task A, and maybe just to read through what they've got and to give guidance in terms of where benefit has been awarded to the candidate. So the candidate starts off with his salutations, saying hello and what they're going to cover in that email, which is all well and good. But then if we go into the review of the actual accounting matters, or treatment, which is what was required of this task, you'll see the candidate starts off to say, the lease is correctly classified as an operating lease in terms of IFRS 16, as the lease does not transfer substantially all the risk and rewards of ownership to the lessee, nor is the lease term for a significant portion of the useful life of the asset. So this part of the response, no benefit is given to the candidate. And most importantly, the candidate here is using lessor principles to assess whether this is an operating or a finance lease. And I think everyone can appreciate that this principle doesn't apply from a lessee's perspective. The only thing that would be relevant from a lessee's perspective is whether we apply the expedient in terms of then treating it as if it's a short-term lease or it's a low-value asset. But in this case, I mean, this would not be relevant to the response for this task. Then they go on to say the operating lease payments are incorrectly expensed as per the simplified approach. The aircraft is not short-term, less than 12 months, nor low value, and therefore on time would not be able to elect a simplified method of accounting and will thus have to recognize the right of use asset in the lease liability. So the candidate comes back here and he definitely explains that lessee accounting, and it's very clear to say that, okay, we need to recognize the right of use asset and that lease liability. So I'm quite happy with this because the candidate firstly gets the right classification for this lease. It's not low value, it's not short term. And then secondly, they talk to us about, what the initial recognition would be. And they tell us it's the ROU and also the lease liability. Then they go on to say paragraph 15 of IFRS 16 states that the lessee should determine the lease and non-lease components. In applying this paragraph, B32 is used to assess as components that are considered to be lease components. The lease components are only the components that the lessee can benefit from the use of on its own or together with other resources, and the underlying assets are not dependent or interrelated to other assets. So I think here I'm also quite happy with this candidate because they've actually identified that there are non-leasing components, but to give the benefit fully to the candidate, we are looking to see if the candidate is going to talk to us about the type of leasing and non-leasing components. And here you'll see they identify the non-leasing components and they explain to us, how we can benefit or how on time can benefit from this on its own. So they talk to the pilots, the cabin crew, the meals, maintenance, and insurance. So I think importantly, ladies and gents, remember there's very little application that can happen at this point. It's stuff that could have been researched by the candidates in the pre-release period, because a lot of this was given in the pre-release period. So really no application yet. It's part of, the candidate demonstrating their understanding of the IFRS 16 treatment. Then they go on to say we would expense as non-leasing components on a monthly basis. I mean, to get a better benefit there, I'd expect the candidate to say something along the lines of the type of expenditure we would then recognize. So I'm happy that this candidate has identified the leasing and non-leasing components, right? But once again, remember, little application here. This is information that candidates could have researched and brought in on the day of the assessment. But I'm also the candidate goes on to confirm we would need to create a lease liability and a right of use, right? So very happy that his initial recognition, or their initial recognition rather, is perfect. Then they say the lease term would be the non-cancelable period of the lease of 18 months, as well as the period covered by the portion option to extend if the lease is reasonably certain to lessee is reasonably certain to exercise this option. So at that point, ladies and gents, I'm a bit underwhelmed here because the candidate is not applying, they're just telling me the theory. Then they say on time would reasonably exercise on time will be reasonably certain to exercise the option to extend, as the option to renew is at a cost of 10% below the prevailing market rate, and therefore an economic incentive to extend the lease. The total lease term should therefore be 3 years. So the candidate hits the spot on where they actually, now, they've given us a theory, and now they've applied themselves to say, okay, based on this information that you've given me, on the day of this assessment, I think it's probable, and this is why it is probable. So we are happy to give benefit to the candidate here, because they tell us, why it's probable. They link it back to that below prevailing market rates, and they then conclude to tell us that it is probable. So they want to use the 3 years, the 36 months. Then when we get to the lease liability, the candidate then says the lease liability will be measured at the present value of the monthly lease payments, as well as the present value of the variable lease payments of 0.5% revenue. Should there be any residual value guarantees, these should be included in the measurement. There will be interest expense recognized in the lease liability on a monthly basis, and the payments will be set off against the lease liability for the period of the lease. So for this candidate, the candidate does well in terms of initial recognition, right? Says it's the present value of the monthly lease payments, but makes a mistake there to tell us that, also the present value of the variable lease payments must be included, which we know is incorrect, because the variable lease payments are not linked to an index or a rate, right? So, they don't quite get the benefit there for the variable lease payments, but there is a little bit of light in terms of the recognition, or the measurement rather, of the lease liability. Then the candidate, the stuff about residual value guarantees is also quite theoretical, and there's really nothing to apply there. And then they tell us about subsequent measurement, about the amortization of this liability. So I'm quite happy this candidate has done initial recognition, initial measurement, and now they are dealing with subsequent measurement of the lease liability. So if we go on to read, they then say for the right of use asset, a corresponding right of use will be measured at the amount of the initial lease liability calculated above, as well as any lease payments made before the lease commences. So happy they've got the initial measurement. They're on the way there, but they go on to further say we should further include direct costs incurred on the lease, however, none are noted. Obviously, that part is incorrect, but the candidate does talk to initial measurement of the right of use asset. We are happy with that, but obviously doesn't quite land as it relates to the direct cost of that lease at that point in time. Then they tell us an estimation of the restoration cost should be restoration costs to be incurred to restore the aircraft and to remove the branding. So I like this a lot, because they link it to the branding, should be included in the right of use asset at the present value of the expected cost at the end of the lease. So ladies and gents, I'm quite happy with this. The candidate, in terms of this new information that's presented on the day, understands that I must include the restoration cost, and they don't just put this in a theoretical sense. They go and they tell us what the restoration cost is. The restoration cost is linked to the removal of the branding, and they tell us at present value. So I'm happy to actually give the application of the removal of those restoration costs. Then they say the right of use should subsequently be measured in terms of IAS 16 and the cost model. You must depreciate at the lesser of the useful life in terms of IAS 16 and the lease term. This will likely be the lease term, given that the lease term is 3 years and the aircraft is 30 years. So I'm happy with this. And what makes me more excited about this candidate is that they continue with the 3 years. Remember, at the top, they had told us that they are going to consider the renewal period, and they were working with 18 plus 18 months. And now they are continuing with that. There's no contradictions in this response. He or she, or they are continuing with that 3 years, which is what they had discussed previously. A nice application here. Then they say significant components of the right of use should be depreciated separately in the manner that best reflects their use. We should recognize a corresponding provision for the future restoration costs at the same present value that was included in the right of use, and unwind that interest on this provision. So this candidate is quite excellent, because then they're telling us, firstly, to capitalize those restoration costs at present value. And then this candidate hits a high level indicator by telling us that, then you must also recognize a corresponding provision, which is excellent. And they tell us about the unwinding of the interest, which is a subsequent measurement of this restoration provision. Then the candidate does discuss some disclosure in their response. So from an accounting perspective, Excuse me, everyone. From an accounting perspective, before we get into the strategic pros and cons, I hope everyone's comfortable that this candidate has actually quite good coverage in terms of demonstrating their understanding of IFRS 16, number one, and then number two, their ability to apply themselves to the information on the day. We saw, if you look at this response, that the candidate speaks about the renewal period, which is new information on the day. The candidate also speaks about the restoration costs, and they apply themselves to the branding. And lastly, the candidate also speaks about, that high level indicator we said here, the future restoration costs that must be recognized as a provision as well. So this candidate does well from an accounting perspective. We can see that this candidate really understands IFRS 16. They've touched on all the critical components of IFRS 16 to correct that accounting treatment presented. And moreover, the candidate has managed to demonstrate their ability to apply themselves on the day based on the new information given. I should then add at this point that even without this HLA, which is the provision that should be recognized, this candidate has done well in terms of their application of the new information that was presented to them on the day. And lastly, they obviously then consider the disclosure. So if we look at the pros and cons, ladies and gents, so first on, wet lease will release on time for many of the responsibilities of operating the aircraft, as this will be carried out by the provider. And then, the con next to that, the wet lease generally works out more costly as you are paying fully for a fully operational aircraft. So for these 2 points, we just needed a little bit more elaboration. Yes, it's costly. Maybe not in the short term, but perhaps in the long term, it might actually be costly compared to the dry lease. So we need a little bit more more application there. When you say paying fully for the operation of the aircraft, remember you were going to pay the costs anyway. It's just that now you're paying it as one lump sum instead of then paying for the costs individually in your own capacity in a dry lease. So a little bit more application would be required here. Then for the second ones, they say the lessor will provide the staff and train and manage the staff, which will reduce the strain on our human resource management, as we will be able to expand our operations without employing more staff. So once again here, the candidate is linking it nicely to the fact that firstly, less of a hassle in terms of recruitment, number one, and and you don't need to train these staff members and manage them. But the con next to that says you'll have less control over the aircraft's day-to-day operations, which may not align to your core values and will not be able to tailor the flying experience. Excellent. So this candidate here really applies themselves in terms of their understanding. And ladies and gents, remember this question is asking, they had said to us, they want to grow the business, right? And they are thinking of wet leases. So this is not specific to the George route. It's about the entity just pivoting, and instead of using dry leases, want to consider wet leases, and those are the pros and cons that they're looking for. So if you look at the next one, they say you'll pay for insurance and maintenance of the aircraft, which can be extremely costly and unpredictable. Once again, remember the lessor is going to price this in, so that's not valid because you're going to pay for it anyway on the dry lease, but on the wet lease, but you're paying for it through a lease payment, so not valid. And then they say on time will have a reputational risk if the customers are not satisfied as a customer, aircraft will be flying as on-time branded aircraft, despite the operations being outside of the control of on-time. So once again, I think that's a very good point. There is a reputational risk here, depending on the quality of experience that our passengers receive. Then they say these leases are generally shorter. We can change or choose not to renew if we are not satisfied with the service. I think this is also good in terms of also, is this going to work or it's not going to work? Because remember, they were looking for pros and cons for actually now looking at wet leases instead of doing dry leases. So growing without expanding operational capacity. Then the last one we gave then was on time will be dependent on the lessor, and this can create a risk if the lessor doesn't fulfill their obligations or if there are transitioning challenges at the start of the lease. Very good point. So this candidate, in terms of strategy, I think we could all appreciate, they've got 3 valid cons, and they've got 2 valid pros. This is a very good, very strong strategic response. And ladies and gents, overall, this candidate, if you think about it, we said the accounting was very strong, ability to apply themselves to the information on the day. Once again, the pros and cons, which is something that candidates could have actually done research on because it was triggered. The candidate is able to apply themselves and give us really insightful detail there. So overall, this candidate, ladies and gents, was graded as competent because they had the ability to demonstrate competence as it relates to task A. So I hope everyone's comfortable with that. So candidate A was then graded as a competent candidate. They had the ability to demonstrate sufficient competence. So let's look at the next script, ladies and gents, to contrast, and I mean, we'll read and we'll talk through this one as well. So we've got candidate G, and candidate G has the salutations as it starts with his email, and you'll see they then go on to say the commencement date has remained unchanged. The commencement date will be the date that on time shall recognize the right of use, asset and liability. So they, I mean, they are happy to give the benefit because they are telling us about the initial recognition and what needs to happen there. Then they say these are terms and conditions of the proposed wet lease agreement and includes information that is pertinent to how we will recognize the lease and the related transactions. If it's 16 only requires lessees to bring the leasing component of a contract onto its balance sheet. This is explained by paragraph 12, which states that for a contract that it contains the lease, an entity shall account for the lease components within the contract as a lease separately from non-leasing components. Looking at the wet lease agreement, which includes provisions of aircraft, cabin crew, ground staff, supporting, etc., on time will only recognize the aircraft as a right of use asset and a lease liability. So for this candidate, I'm quite comfortable that they understand leasing versus non-leasing components. Once again, remember, this is stuff that could be researched in the pre-release period. So, I mean, they do tell us, you know, and some of the stuff, a lot of it actually was given in that initial agreement for this wet lease for on time. Then they go on to tell us about, you know, the allocation of payments between the leasing and the non-leasing components and the fact that it must be based on relative standalone selling prices. They go on to tell us that, you know, the separate components of the contract will be recognized and measured under a different IFRS. Most of these would be expenses and profit or loss. Profit or loss as an expense as incurred. So once again, like, a link to the type of expenses we're talking about, because the candidate has given me the type of non-leasing components. So definitely there was scope to really apply yourself as it relates to that. Then they also talk to us about the practical expedient in terms of recognizing leasing and non-leasing components. So far, in terms of understanding IFRS 16, are you guys happy that the candidate has the initial recognition of a right of use and lease liability? And furthermore, they've gone to tell us about the leasing and non-leasing components. Then they tell us about the rights to the lessor. Then monthly payments and arrears will be separated into in relation to the relative standalone values of the goods specified in the proposed agreement in order to determine what portion of the payment relates to expenses such as insurance, etc. Variable lease payments that are calculated at 0.5% of total revenue generated by on time are not yet determinable. As such, they will constitute the need for on time to remeasure the lease liability once we are aware of the amount of revenue generated. So once again, that's technically incorrect in terms of those variable lease payments. Then they say this essentially means that the lease liability will be remeasured based on the variable lease payments that need to be made only next year, actually in 2025. This remeasurement will be made at the end of next year, 2025, when we have more certainty of our exact revenue figure. So once again, technically incorrect there. Then they say any branding of the aircraft by on time will constitute a leasehold improvement. Leasehold improvements will be impaired over the term of the lease. Since the lease is 18 months, the branding costs incurred will be impaired over 18 months. Once again, really not relevant for this task, right? Yeah, so no benefit given there. An estimate of the costs required to return the aircraft to its original condition to remove the branding at the end of the lease will form part of the cost of the right of use asset in terms of that paragraph. So once again, ladies and gents, if the candidate didn't include remove the branding, we didn't give benefit because of the limited application to the information on the day. Remember, the standard tells us to include restoration costs and the cost of the right of use asset. But in this case, we definitely wanted the candidate to link it back to the case study to say the cost to remove the branding. Then they say the discount rate to be used in measuring the lease liability for future lease payments is the interest rate implicit in the lease. However, that would require on time to have knowledge of the underlying aircraft residual value and fair values. This information contained in the proposed agreement is not clear. So I mean, I'll take that. But then, I mean, they go on now and say this information is not available. We may use the incremental borrowing rate, the rate that we would apply to borrow necessary funds over a similar term with similar security. On time does have this information because our experience with dry leases, however, the rate would be adjusted for the least specific risk and will require a significant amount of judgment. So, I mean, valid in terms of initial measurement of that lease liability. Once again, that still falls under, the candidate's ability to understand IFRS 16. We haven't really seen much application of the information on the day. Yes, they've hit the removal of the branding, but that's all we've seen up until this point. Then they say the leasing accounting standard is not the only standard that's applicable to this agreement. But I feel like this candidate is, did I go up now? Yeah, the candidate is repeating what they had, but let's read it. Agreement, they require us to separate the leasing and non-leasing components. Aircraft should be recognized as the lease, while the remaining services supplied and the approval should be recognized in different terms. Then they tell us pilot and cabin crew, maintenance, aircraft, and insurance will be needed to be expended based on their relatives. So this is technically a repeat of something we've read already. Once again, I think be very careful in terms of, demonstrating professional competence. There's really no need to repeat this because this was already included earlier on in the response. Then they say, I disagree with the classification of the leases and operating lease. It requires a lessor to classify each of its leases as either operating or financing. Since On Time is going to lease the aircraft, we need not classify the lease as either operating or financing. Instead, at the inception of the contract, we shall assess whether the contract contains a lease. A contract is or contains a lease if the contract conveys a right to control the use of an identified asset for a period of time in exchange for consideration. On Time would therefore need to assess whether the contract conveys the right to use an identified asset for a period of time, as well as whether there are any identified assets that are explicitly set in the agreement. In assessing whether On Time proposed agreement conveys the right to use of the Airbus 320 aircraft for a period of time, we will need to consider whether throughout the period of use, we have the right to obtain substantially all the economic benefits from the use of the identified asset. On Time will benefit substantially. On Time will obtain, substantially all of the economic benefits, or rather revenue generated from the wet lease throughout the 18-month period of the lease. We therefore have the right to obtain substantially all the economic benefits. Okay, so here, I mean, the candidate is just basically trying to prove whether we've got the right to control and we've got an identified asset. But let's keep reading. Whether we have the ability to direct the use of the asset. On Time will have the ability to direct the use of the asset because it will be able to determine the flight route it travels on. On Time will have the exclusive use of the aircraft for the period of time. The requirements of a lease are therefore met, and therefore the proposed agreement therefore contains a lease. In terms of IFRS 16, the maximum period of 3 years will not be the minority of the estimated useful life. The useful life will be determined in terms of the length of the agreement and the likelihood that we will renew it. So all of this, I mean, as we're reading it, I'm sure you guys are comfortable, quite theoretical. Yes, forms part of the understanding of the candidate's understanding of IFRS 16. But let's see if there's more here. So then they say the operating lease payments are expensed as they are incurred. However, in this instance, On Time as the lessee will have to apportion these lease payments according to the lease components and non-leasing components. This is something that the candidate already addressed at the top, where they told us about splitting these components and non-leasing components. So once again, something to be careful of as you demonstrate your competence. Then at the commencement date, On Time will recognize a right of use asset at cost, which will comprise of the following: the amount of initially measured for the lease liability, which shall be the present value of the lease payments that are not paid, any lease payments made at or before commencement date, less lease incentives, any direct costs incurred, an estimate of the cost to return the aircraft to the lessor. So once again, very theoretical, but we are happy that they are talking about the initial measurement, right, which is part of their understanding of IFRS 16. Then they say, a corresponding lease liability must be recognized at the present value of the lease payments that are not paid at that date. So I'm happy with that initial measurement of the lease liability. A portion of the payment relating to the lease will therefore be allocated to the lease liability. Interest correspondingly be raised. That will increase the lease liability, and the other leg of the transaction will be finance costs. Happy subsequent measurement of the lease liability. Variable lease payments will result in an adjustment to the lease liability. The lease liability will have to be recalculated and remeasured. In 2025, the lease payment relating to the variable payments will be allocated not as an expense, but will increase the lease liability. So that's technically incorrect. Then they tell us about the subsequent measurement of the right of use and the fact that we need to depreciate that. So I'm happy to give the candidate that. And then the candidate also gives us the disclosure that would be required. So I hope you guys are comfortable. I mean, this candidate, if you look at it, so I think in terms of understanding IFRS 16, there are some few inaccuracies that we've got here. The candidate, in terms of applying themselves on the day, I think the only information on the day that they managed to successfully land or successfully apply is the removal of the branding. And I mean, remember in the training, there's like 4 aspects that the candidate can talk to. There's 2 branding aspects. The removal of the branding, branding is an initial direct cost. It's a renewable period, and it's also the variable lease payments. So in this instance, the candidate has only managed to unpack only one of those components. And their understanding of IFRS 16, while it is okay, there's a lot of repetition. There's a lot of inaccuracies and technical inaccuracies that then come through in this response. Then the candidate goes on in terms of things that should be considered. We should consider whether there are any, so I read all of this, yeah. We'll consider there's any substantive substitution right which allows the supplier to substitute the aircraft with a different aircraft throughout the period of use. And the supplier may potentially benefit economically from this exercise. Once again, guys, if you keep reading that, the candidate doesn't apply themselves. Linking this to the branding, that the lessor would have to unbrand the airplane and then rebrand, which is potentially not economically viable, then means that there isn't a substantive substitution right. So application, application, application. Then they say we should consider whether the lease agreement will be with a related party such as First Regional Bank and possibly related party disclosure. So really, no, not particularly relevant for this task, because this would be note disclosure. And here we had to just critique the accounting treatment. We should ensure that the interest rate implicit in the lease is calculated based on the aircraft's underlying asset and fair value. Also not quite relevant because we'd probably use the incremental borrowing rate. So not happy with that. And then we should determine whether the practical expedient is applicable and whether the standalone selling prices of the other components in the lease can be calculated. Once again, no benefit particularly given for the candidate there. So what we gave benefit for in terms of the pros and cons, but maybe just to conclude on the accounting. So the accounting for this candidate is not particularly strong. So the information on the day, I mean, they just only managed to land one of those. And if you look at the understanding of IFRS 16, it's there, but I mean, it needs, there's too many inaccuracies, technical inaccuracies. So maybe from an accounting perspective for this candidate, we could say, okay, this candidate, maybe if the accounting is not strong, maybe at the lower end of BC, if we are being generous. But if you look at the pros and cons, the pros and cons that we gave then is, the culture of treating customers, the crew might not have the same corporate values. We are happy to give that one. And then the other one we were happy to give is the candidate then explaining that entering into a wet lease agreement will provide with immediate economies of scale. So it's actually faster to get into. We want to grow. We can actually get on and do this. It allows us to reach the market by servicing new customers, and simultaneously our total revenue will be increased. So that's the other one we gave in terms of the strategic pros and cons for this candidate. And overall, ladies and gents, I think we can all see which direction this script is going. The pros and cons are not particularly strong, would say. I mean, perhaps they are also like a BC. And overall, this candidate, we said, has demonstrated limited competence where the accounting is just not there. Too many inaccuracies, too many not sufficient application of the information on the day. The pros and cons are also very skimpy. And I mean, these pros and cons could have been then researched adequately during the pre-research period. So overall, ladies and gents, candidate G on task A was then graded as limited competence. I hope that has been very helpful. Thank you very much.